In May of 2014, the FASB and IASB issued a global standard on revenue recognition, which is one of the most significant developments in accounting standard setting in many years. The standard is driving significant debate as it supersedes existing guidance and replaces it with a FiveStep model that is applicable to all industries. This podcast will focus on some key impacts on revenue contracts in which the entity provides software as a service, or SaaS. My name is Brian Schilb, and I'm joined by Narayanan Balakrishnan, who is a partner on rotation in KPMG's Department of Professional Practice. The core principle of the revenue standard is that an entity recognizes revenue to depict the transfer of promised goods or services to customers in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. To achieve that core principle, the standard includes a five-step model. First, identify the contract with the customer. Second, identify the performance obligations in the contract. Third, determine the transaction price. 4, allocate the transaction price to the performance obligations. And 5, recognize revenue when or as a performance obligation is satisfied. In a SaaS arrangement, a customer is obtaining access to software that is hosted by the software developer. In other words, the customer does not generally take possession of the software, but rather logs on to the developer's website to use the software. So Narayanan, in a SaaS arrangement, would that be viewed as more of a software arrangement or as a service transaction under the new standard?
Brian, this is one of the important questions which will impact companies in the hosting space. A key question under current US GAAP is whether a SaaS arrangement is a software licensing transaction or is it in the nature of a service transaction. If the customer has the right to take possession of the software at any time without incurring a significant penalty, and they can operate the software in their own hardware or a third-party hardware, the arrangement under current GAAP is viewed as a software licensing transaction. If these conditions are not present under current GAAP, they are viewed as a service transaction. Under the new standard, no such bright lines exist. However, there are examples which suggest that a license that the customer can benefit only in conjunction with a related service or by accessing the vendor's infrastructure is not distinct from other goods or services. In those cases, the customer does not take control of the license without the hosting service. In such situations, hosting transactions would have to be accounted as service transactions. However, it is unclear as to how in practice a hosting arrangement which could prominently embed software licensing characteristics will get accounted under the new standard.
If it is a service transaction, what's the implication there? Does that mean it'll be recognized over a different period of time?
There are specific accounting guidance that is available in the new standard for a software licensing transaction. Those specific implementation guidance would not have to be applied, and the general overtime model of revenue recognition would have to be applied for transactions which are deemed to be service transactions.
In SaaS arrangements, often the payments for the delivered elements are contingent on successful provision of the undelivered elements. Current US GAAP limits the amount of revenue that can be recognized on a delivered item to the non-contingent portion of the arrangement, even when delivery or performance is substantially within the entity's control. Does the new standard carry forward this limitation?
Under the new standard, if the consideration is estimable with sufficient confidence, the current limitation on revenue recognition will not apply. This will result in earlier revenue recognition for most of the multiple element arrangements.
Under current US GAAP, the capitalization of customer contract acquisition costs and fulfillment costs, such as setup costs, is an accounting policy choice and practice is mixed. What's the position of the new standard with regard to customer acquisition and fulfillment cost capitalization?
Brian, with respect to, I would like to talk about the costs under two buckets. One is the customer acquisition cost, and the second one would be the fulfillment cost. Talking about customer acquisition costs, the new standard will require capitalization and amortization of the incremental customer acquisition costs. However, a practical expedient is available for customer acquisition costs. In case the amortization period is less than 1 year, in that situation, a company will continue to have an accounting policy choice of either to capitalize and amortize or simply expense the customer acquisition costs. However, for fulfillment costs, which are in the nature of directly attributable contract costs, which are not covered by any other accounting pronouncements under existing GAAP, those would have to be capitalized and amortized, and there is no practical expedient available for such fulfillment costs under the new standard.
The effective date of the new standard for public business entities and certain not-for-profits is for annual periods and interim periods within those years beginning after December 15th of 2016, and no early adoption is permitted for companies applying US GAAP. For all other entities, there is a 1-year deferral. I should also mention that there are significant new quantitative and qualitative disclosures that will be required by the new standard. The standard allows different transition approaches that an entity can elect. First, they can elect to apply the standard retrospectively, in which case they would adopt the standard, again, for calendar year-end public business entities, they would adopt the standard on 1/1/17, and they would have to restate their 2015 and 2016 comparative periods. There are some practical expedients that are optionally available to companies to use when they're applying the retrospective approach. Alternatively, the company could transition to the standard using the cumulative effect at the date of adoption, in which case they would adopt the standard again on 1/1/17, but they would not restate 2015 and 2016. Instead, they would determine whether contracts are closed as of 1/1/17, and if they're not closed, meaning that all the revenue hasn't been recognized yet, then they would apply the standard retrospectively to those contracts, and any difference would be recognized as a change in beginning retained earnings on 1/1/17. So I'd like to thank our listeners, and I'd like to thank Narayanan for his participation in the podcast today. For additional information, refer to KPMG's Financial Reporting Network, including the latest on the revenue recognition page, which links to KPMG analysis on the new standard, including defining issues, webcasts, and other podcasts.